All right, so we just finished talking about deferred expenses. Now let's talk about deferred revenues, which is pretty much the same thing except on the revenue side rather than the expense side. Expenses, we're dealing with the things that we prepaid that will eventually become expenses. The deferred revenue is the things that somebody prepaid us. We considered them unearned because we haven't done anything for them that will eventually become earned revenue. And so deferred revenues are the cash received in advance of providing products and services. And once the products or services have been rendered, then those liabilities become earned revenues. So this is really specifically dealing with unearned revenues becoming earned revenues. So again, in the last chapter 2 example, we had an unearned revenue. So let's let's see how that would work with an adjustment. So December 31st, of the $18,000 that we prepaid or that was prepaid to us in advance from a customer, Bravo Company earned $9,000 of that. Okay, so we had a specific date that they paid us for a year, and then so again, this is one that we could essentially easily do calculations wise, and I'm going to show you how to do that. But they give it to us here. We know that we've earned $9,000 of that $18,000. But let's look at the calculations real quick. Again, we're going to start with what we were prepaid, which is the $18,000, and then we're going to multiply it by, again, the numerator is going to be the number of months from the start date to December 31st, which for us is going to be 6 months. And then we're going to divide that by the number of months in total for the services rendered. So it's for a year, so it's going to be 12 months. So essentially we're saying we've earned half of that $18,000, and that's where that $9,000 comes from. So again, they could either give it to you if they're really nice, or you can do the simple calculation here to figure out how much of it you actually earned. Another way of looking at this is that we've earned $9,000 of it this year, and then next year we'll earn the other $9,000 of it. But we can only claim what we've done this year because we're at December 31st. We have to do the adjustment at December 31st. So let's put this into our journal entry. Let's post it. Again, December 31st, we're going to put this in as unearned revenue of $9,000. Why? Because we're losing that unearned revenue. It's not unearned anymore. We're taking it out. And again, this is a liability, so it's going to go on the debit side because we're lowering it. It's minus plus. And then we're going to credit our earned revenue account. For us, we're calling this consulting revenue because we already have a T-table called that. And so we will credit that account. And then we're also going to post them into our T-tables. So again, there is my unearned revenue at the top. And then there is my consulting revenue under the consulting revenue T-table. So that's how we deal with deferred revenues. Appreciate it.